Hello, and following the publication of our most recent Sigma, A Perfect Storm, Natural Catastrophes and Inflation in 2022, I'm very pleased to be joined by Martin Bertogg, who is the head of Cat Perils at Swiss Re and is the person who leads our modelling on natural catastrophe and perils. Martin, thank you very much for joining me today. Tell us, really, what are the headlines about 2022?
2022 is adding an additional year to some more than 50 years of that specific research we do to kind of explain to us, but also to the whole industry, the natural catastrophe landscape and how it's evolving. 2022 has been, everyone knows, a very busy year, both in terms of severity of single events, but also in the frequency of events hitting the whole globe quite equally. There have been 125 billion US dollars of insured losses paid by the insurance industry, an impressive figure. This follows more than 120 billion in last year. It's way above the average of the last 10 years. So a remarkable year in that sense. Hurricane Ian has been kind of the culprit of nearly half of these losses, 50 to 60 billion US dollars coming from that event. But the rest of the world has not been spared by hailstorms in France, by severe flooding in Australia. So a year with a lot of lessons learned for the industry.
Okay. So Martin, 2022 in context, tell us a little bit about the longer term trends that we're seeing.
2022 had a high insured loss of 125 billion US dollars. While if you take a step back and look at 2 or even 3 decades from our research perspective on how these losses developed, it doesn't look that exceptional anymore. There's actually a quite constant annual growth rate of 5 to 7% per year on these 2 or 3 decades and that time horizon. That's one observation. The other observation or finding from our research is that severity is kind of the main culprit of that. So if an event happens that the outcomes are more severe, growth in economic values is at the core of that, rather than the frequency, the probability of having more events, where maybe climate change is part of the mix, but it's growth of economic values, which is a key driver, also shown in 2022 again.
Okay, so when I look back to, as far back maybe 5 years to 2017, it seems like natural catastrophe losses have sort of taken a step change. Is that the case?
That's indeed the big question, particularly in 2017, popping up. Is there a new normal? Did something break? Has climate change unfolded on us? And now in hindsight, 6 years later, we see that the average of insured losses in these past 6 years have been way above 110 billion US dollars. So it looks like more a steady state in a sense. Well, even that's decisive that from 2012 to 16, the industry or us as a society got a bit misled that natural catastrophe activity was at a very low level compared to anything before and now also after. So 2017 actually is not a new normal in our research, it's rather returning to the normal. And the normal is actually at a high elevated level and it's a growing pattern, so not steady state, but 5 to 7% growth per year.
Yeah, and are we seeing climate change in the numbers here?
Climate change is certainly in the mix, with perils closer to humidity, so torrential rainfall, wildfire, drought. While it's not the major driver in our research explaining this growth, it's severity, which is mostly driven by economic value growth. And it's not a natural economic growth all across, homogeneous, but economic values also tend to grow in urban environments, urban settings, which are particularly exposed to natural catastrophes as well, on coastline, on river settings, typically exposed to a lot of water or extreme weather perils.
Okay, and then in the report we talk about Hurricane Ian in the lessons learned section. Tell us a bit about what we learned with Hurricane Ian.
Hurricane Ian is interesting from 2 angles. 2022 was predicted as being an above average hurricane season, so with more than just the average number of events happening. That didn't occur. It was actually lower than that, the average. But on the other hand side, Hurricane Ian hit the coastline with on the Florida coast with a population increase in the last 50 years of 620%, a staggering amount, telling a story. That same storm 50 years ago, probably people hardly would have noticed nowadays, a big catastrophe. So it just takes one of these hurricanes to distort already at least the 1 year statistics, not the overall 3-decade statistics, but the 1 year statistics.
Okay, so back to 110 billion years going forward then. Tell us finally just a little bit about the lessons from a risk assessment and an underwriting perspective, Martin.
This, in the industry, we tend right now to think in two categories. I was speaking about Hurricane Ian, which you call a peak peril. Hurricanes, earthquakes, these perils affecting capital positions in the industry have been traditionally now well modeled. There's an established best practice across the whole value chain to collect exposure data, use models, share model results. So a very established practice. When it comes to what we would call secondary perils, which in today's notion are the perils just getting less attention. That's hailstorm, that's wind, wildfire, flooding in particular. In the last 10 years, a lot of model assets have become available, but they're not used in that disciplined manner as we see it on the peak perils. Exposure data is missing, the models are not actively used or shared within this value chain, so the industry can crank up their discipline and add to the sustainability of having a robust risk assessment for now and also for the future in this growing risk landscape.
Fantastic. Well, Martin, thank you so much for taking us through the NatCat Sigma 2022. And thank you for watching. If you need more information on the NatCat, you can find that on the Swiss Re website. And there's other collateral there that will provide more insights. Thank you very much for watching.